Welcome to Investing Matters, and this is your host, David Silva. Debt to GDP means the debt of a country to its gross domestic product. In other words, the growth of the country. If the country is not growing and its debt is increasing, this ratio here tells you about how much the country is in debt. And of course, the higher the figure, the more indebted the country is to its GDP, which is gross domestic product. So, as you can see, United States, Japan, and Italy are way high on their debt to GDP. Okay, please notice in Russia, the debt to GDP is only 17.70%, and you will see what the bond yields of these countries are doing, like say Russia and South Africa, where the debt to GDP is way lower. This is South Africa's government debt to GDP. Okay, they're sitting at 50.1%. All right. Yes, their debt levels are starting to have been going up in the last couple of years. The last 2, 3, 4 years have been going up, but still nothing compared to the debt levels of the US, Japan, and Italy. A government bond is how much, well, put it this way, a country will issue bond if it needs to borrow money. Okay, and the higher the yield, in other words, like you see here in Russia and in South Africa, the higher the yield, the more it costs that country to borrow money. And this here illustrates the 10-year bond. Now this is the 10-year bond yields in the first 4 countries here. Well, the Euro area, which is a whole bunch of countries. Okay, then Switzerland, Germany, and Japan, they are at negative yields. Okay, then you have United States. You're only getting 1.63 as of the 26th of August. For you holding a 10-year bond, treasury bond. Okay, then you look at South Africa, whereas I just mentioned earlier that the debt to GDP is not as high as the other countries are, and Russia, which is the debt to GDP is 17%, they have to issue bonds at 8.31%, when basically they almost have no debt. This all doesn't make any sense. Even Greece is lower, that's completely bankrupt, and Portugal, that's bankrupt. They are only paying 3.04% in Portugal for their 10-year bond if an investor buys their bond, whereas in Russia and in South Africa, where the debts are way lower, and those countries are not bankrupt compared to a lot of the other countries here above, including the US, where the debt to GDP is much higher, over 100%. And look at Italy. Italy, the banking sector right now is completely broke. They need a bailout, and you're only paying 1.13% to buy a 10-year bond from Italy. Who in the right mind is going to be financing or buying bonds in these countries that are completely broke and giving you no yield? Okay, I know what I would be doing. I'd be buying the bonds of Russia and South Africa, because their debt to GDP is way lower than all these other countries. So the 10-year bonds of all the developed countries, Europe, the US, have been going down in yield, whereas in some emerging markets, as I explained, South Africa and Russia, where their debts are nothing compared to the developed markets, their yields are way higher, which doesn't actually make sense. And now here is another thing that actually doesn't make sense whatsoever. The LIBOR rates, which is London interbank borrowing rates, from a year ago, the 1 month, 3 month, and 6 month LIBOR rates, what they were a year ago, let's say the 1 month at 0.20%, it's gone up more than double now. Then the 3 month is 0.33%, is now 0.83%, and the 6 month LIBOR rate from 0.52, it's gone to 1.2 2-3%. So that means there's risk in the banking sector, and the banks are lending money to one another at higher rates, so there's more value. But yet, in the bond market, the yields are going down. This doesn't actually make sense. Obviously, it's the central banks manipulating the bond market by buying their own bonds to keep the yields down. But in the banking sector, it's telling you a different picture. It's telling you that the cost of capital is increasing in borrowing. And these two are totally disconnected, the bonds between the LIBOR rates. And it will be interesting to see what will happen, okay, because this is totally disconnected from one another, the bond and the LIBOR rates. And we'll see how it will all come out, whether it's the LIBOR rates being manipulated up in yields, which, don't forget, the banks have been caught manipulating the LIBOR rates, but usually they're manipulated down, not up. And the bond yields, where the central bankers are buying their own bonds to keep the yields down, obviously that's why the problem is, and not the LIBOR rates. So we'll see how all this will fall out at the end. Okay, bye.